I'm Matt Kwatinetz, professor at NYU and also the director of the Urban Lab. I'm really pleased to have these panelists here today. We'll go through introductions in 1 second. I just wanted to set a little bit of context about why we're talking about sustainability and affordability in a capital markets conference. There's obviously been quite a sea change that has happened in the world through COVID. Also increasing pressures around affordability in the city of New York. We have increasingly seen that we're in a crisis just overall of housing units. Rodney recently said we'll fall short almost 600,000 units by 2030, just of market rate units, without any further in-migration or any changes to the housing stock. Our current regulated stock is almost half of the stock of rental apartments, and yet still we have 1 million people that are rent burdened here. So we're expecting to see some pretty big policies headed in the direction to try to increase that. And at the same time, we have the rising issues around climate change and environmental justice. Of course, Local Law 97 here that's been passed is going to cause a huge amount of capital to be flowing into buildings. In a lot of cases, we're unclear where that capital is going to come from or what the timing is. And at the same time, you have the Inflation Reduction Act that's provided 6 or 7 different grant or funding tools for that. So we're going to try to hit on all of those things briefly as we go through. We might get to also speak about the social bonds issuance that the Adams administration recently did in October. But let's start out by doing introductions of the panelists, and then we'll go from there. Steve, you want to start?
Sure. Great. Hi, everybody. My name is Steve Benjamin. I'm the CEO of the Dermot company. I've been in the multifamily business since the early 90s. I'm also an NYU alum, graduated in 94. It's great to be back. It's great to be live, right? I haven't been on a panel since COVID, so it's great to see everybody and to be here. Our company is focused on, we're a New York-based company. We are focused exclusively on multifamily. We're a vertically integrated company, so we've been managing and developing and handling our own operations and investing on behalf of partners for years. At this point, I feel like I'm getting older because I really don't have any other skills. So, but I'm excited to be on the panel. You know, both issues, though we were talking in our stuff, they're very different issues in a way, coming together like this. But certainly for New York, and I think more and more nationally, affordable housing is one of the key points moving forward, and is the future of housing. You can't be in the market rate business without having some component of affordability in what you're doing. Certainly that's the MO in New York, but more and more it's becoming the MO nationally. We have a business in Florida. We're redeveloping a property. We're adding some density and building units down in Palm Beach County, and we're going to be adding affordability as part of their regulation. So it's not just a New York thing. It's not just an urban city thing. It's definitely national. So it's great to be here. I'm more on the market side where affordability is a part of what we're doing. We're very focused on market rate. You know, I'm eager to, you know, answer questions, et cetera.
Great. Good afternoon. I'm Paula Carruthers. I'm the Director of Real Estate for the Archdiocese of New York, which essentially means that I manage and oversee the real estate portfolio for all of the Catholic churches from Staten Island, Manhattan and the Bronx, and New York City, all the way up to Albany, essentially. It's quite a bit of land, quite a bit of diverse portfolio. We have everything from vacant land to churches to residential buildings, parking lots, school buildings, tons and tons of school buildings, and sort of everything in between. We're really in a time when leveraging those real estates is key to essentially the survival of the church and making sure that we're finding the best use for our properties. Prior to this, I was working in the city of Detroit, mainly on innovation developments there with Ford Motor Company and the University of Michigan, and looking at redevelopment of sites that have been long vacant for about 40 years. Detroit, I think, is like many cities around the country where there's significant interest in particularly in the capital world, and folks trying to figure out how to invest in projects there. The margins are incredibly thin, really challenging, such a diverse or different sort of market from New York City. but I had a lot of fun there. And then prior to that, I was back here in New York for many years, mainly on the public side, working in affordable housing with Gary at the Housing Development Corporation, as well as the city's Economic Development Corporation. So glad to be here.
Good afternoon, everybody. My name is Gary Rodney. I oversee affordable and workforce housing for Tishmen Speyer. Many of you probably know Tishmen Speyer as an office developer or an owner of office properties across the world. But I joined the firm about 2.5 years ago to launch this new business. I have a long history in the affordable housing space. I've been doing it for about the last 24 years, doing a number of different things, including financing it, developing it, and structuring and asset management over the long term. So what I'm doing at Tishmen Speyer is we've built a pipeline of about 2,000 affordable units to be developed in New York City. But this is a national platform, so we're also scouring different parts of the city to purchase assets, both on the affordable side, which I'll call capital A affordable, which has a true deed restriction, or workforce housing, which in my industry sometimes here called little a affordable. And again, areas across the Sun Belt and major cities across the country. Prior to joining Tishmen Speyer, I used to run a low-income housing tax credit syndication firm, which I know is a mouthful for folks who are not in my industry. But basically what we would do was raise capital from institutional investors and then invest it in affordable housing. And then we would asset manage that for a 15-year compliance period. And prior to that, as you heard from Paula, we worked together at the New York City Housing Development Corporation, which was an agency I ran for a couple years, where we were one of the largest multifamily issuers of debt in the country. So we financed the lion's share of multifamily affordable housing projects in the 5 boroughs of New York City, in addition to providing low-interest subordinate loans. And prior to that, I was an affordable housing developer. So you'll hear a lot of different perspectives here, but my focus is squarely on the affordable side.
Thank you all. We're so happy to have such a diverse and interesting group of experiences here. The way this is going to go down is I will ask 2 or 3 questions that one panelist will lead, and then they'll jump in. And I'm going to get the card signal from the back when we have about 15 minutes left. And we do have some mics in the audience, and you're welcome to ask whatever questions you'd like. We'd like to get those perspectives. If somehow in the room there aren't questions, I have a whole other list, but I don't anticipate that to happen. So let's start with affordable housing. Recently, the AIA and NYU Schack, the Furman Center, some other folks were looking at the affordable housing crisis in New York and asking if it was any different than it had been before. Is it more significant? Is it less significant? And when we looked at the overall rental inventory in New York City, the rental inventory of apartments is about 2.3 million, of which fully half is regulated at some level, which doesn't make it capital A affordable, but it is regulated in some way, and yet we still have 1 million rent burden today. Rent burden means people are paying 30% or more of their income, household income, on their rent. Recently, we've had the loss of 421A. We have seen these supply and demand issues. Obviously, construction costs are increasing. We don't yet have an ADU law here. There's a lot of factors that are coming together so that when we do the math on how long it would take at current production levels to actually address the rent burden, it's 65 years at our current levels of production. And that assumes 421A is back, by the way. So I'm curious from the panel, when we think about developing affordable housing at all right now in New York City, let's start the conversation with, is that even economically possible? And secondarily, what are some of the financing tools or zoning tools or other tools you'd like to see to help advance the production? Does anyone want to start? You want to walk us through the economics?
It's definitely economically viable, but you need help. And the typical capital stack for an affordable housing deal, you'll probably have 4 or 5 different sources, including some low interest money from some entity, whether that's the city, the state, or some municipality. But you need some sort of help to be able to do that, in part because you're agreeing to restrict the incomes of the tenants that you're renting to, which means there only so much can be paid in rent. So you have to make it up somehow. because whether you're building or purchasing, the cost of that asset is gonna be kind of the same, right? You know, the cost for me to put up an affordable housing project may be a little bit less than it's gonna cost Steve to put up a market rate project, but it's still gonna cost significant capital. So I do that by leveraging those public sources in addition to something called the low-income housing tax credit, which is something I had mentioned earlier, where you get an investment from a capital partner. What that capital partner receives is a break on their federal tax returns for a 10-year benefit. So there's incentives that are being done all around there to incentivize private infusion into that affordable housing, but that's how you make it work.
One of the things that we've seen in the market, and you know, at any given time, we have a number of properties that we're thinking about how best to utilize, and you know, it's most easy when we have a large site that, you know, we could partner with somebody like Gary on developing, or with Stephen on developing. You know, for the most part, everything in New York City and in our boroughs, you know, was utilizing 421A. So sort of the loss of the tax credit, and I think everyone in the room knows, has been a real sort of hindrance. But in addition, on the affordable side, everyone that's building an affordable housing project is sort of going to the same well to get the financing. They're going to the state or the city. And that backlog right now is, you know, 3 to 4 years you can be in that pipeline. So in order to, you know, leverage a site, someone has to be able to hold on to that site for 4 years, you know, while they're working that deal. And we found that layered on top of just the significant need right now, obviously, of housing, like Matt mentioned, but particularly, I think, you know, coming out of the pandemic, it's really hit, you know, the families that are at the lowest incomes. Affordable housing in the Bronx right now, on average, is above market. So even the affordable housing that we're subsidizing and building is not attainable by the people who live in the communities there right now. And there's, you know, long been debates of what really makes something affordable, right? Are we building things affordable? I think, you know, those of us that have been on the policy side of it, you look at the numbers and you see there's not just a need at the low income levels, there's also a need at the middle income levels. You have, I think, probably some of the students coming out of Schack right now that are, you know, doubling up and, you know, renting rooms, you know, 3, 4 to an apartment, because when you get a job with a college education, you're not making enough necessary to live in your own apartment, you know, even in Brooklyn anymore. And so, you know, the need for affordable housing is that huge range, and right now we limit that to, you know, about 130 AMI, which is, you know, references the area median income that's set for the region. You know, and I would argue that really, I think, as we think about with 421A, you know, we know that the governor is looking to do longer periods of affordable housing, deeper levels of affordable housing, and layer in some of these, you know, carbon neutral type benefits. And then we know the unions are going to have a say. You start layering all that in, and on top of it, we're capping affordability. There's huge swaths of people who are not being served at the very, very low level and at the middle income level, both of whom need homes. And I think that leads to some of the challenges that we're seeing in business with, you know, not enough housing people, especially, you know, right now. I think we're seeing that we're creating the jobs in New York City. We don't have the housing. So a lot of people working in our New York companies are living in some of these, you know, tertiary cities.
And just to put a finer point on the point that Paula just made, on average, at least in New York City, when an affordable housing project is developed, you get about 900 applications for every unit, which is insane, right? But that speaks to how intense or how dire the situation is right now. So to where you started, Matt, I think there is an affordable housing crisis right now, because when we're at that point where you're getting nearly 1,000 applications for every one unit, I mean, that's one of the reasons why this is a great business, because if you buy a property right and you can build it with all the other challenges you have, you're gonna have people to live in those units, and you're always gonna have a flow of people who are looking to move in.
sort of an infinite demand, counter-cyclical moment. Can I just ask one thing before we go to you, Steve? Give us a sense, I know y'all are working on a project together, give us a sense of what a single unit of affordable housing costs and what you'd expect the yield on that to be with income restrictions.
Well, my answer today is probably different than it would have been 4 months ago. Look, on average, it's going to cost, you know, we're approaching $500,000 a unit just to get it for acquisition costs, construction costs, kind of putting us in a position to kind of make this work. What we're struggling with right now, which I think a lot of people are seeing, is construction costs are all over the place. Interest rates are all over the place because of what's happening in the environment. So we're in a situation now where we have to do some value engineering on our development deals or any acquisitions that we're looking at. Kind of, obviously there's going to be price adjustments, but what else do you have to sacrifice in your deal to kind of make it work? We are actually working on a transaction together where I purchased a site from the Archdiocese earlier this year. And we're putting 340 units of affordable housing at a range of incomes in the Bronx. One of the cool things about it, though, is in order to kind of make these economics work, is it's a full block site. We were able to put a third of the site working with the city of New York to bring a new public school to the area. So it kind of works in a lot of ways because you're serving these needs that are needed in the community, both providing affordable housing and the need for a new public school. And for me, I got to offset some of my costs on the acquisition by sharing the costs with the city on purchasing the school. So you're going to see a lot of different levers get pulled and a lot of different things that come into the equation. But for us, that was one way to, one, provide the need that we wanted to have, but still be competitive in a market where at the time we were bidding on this, 421A was still available. So that was a way I was able to be competitive as an affordable housing developer.
Talk about, Gary, just maybe how much public subsidy goes into that 1 unit of affordable
Well,
housing.
it's still being negotiated, but the lion's share of that capital stack on that project is coming from public sources. But in exchange for that, we're agreeing to provide affordable housing at extremely low incomes up to moderate incomes for up to 30 years. So that's the trade-off that we're giving for it. But in exchange for that, we're getting probably close to 55 to 60% of the capital stack is being funded from these other sources.
So, Steve, I know you've had a portfolio of mixed income. You've done a lot of work with rent stabilization, and also you had some comments on our pre-calls about 421A. Curious, how do you think about yields in those different situations? What tells you to transition out from one to the other? And then we can turn to 421A and the tax regime here.
Okay. I don't get let out very often, so I have to be careful. So. Maybe I'll just start with sort of what we went through as a company. So we did, a lot of folks here might know us more as a development company, but the truth is we haven't been able to buy a site in New York since 2012. The last project we finished was 21 West End, actually Rob's the lender on it. We finished it in 15, and we just found the market to be getting tougher and tougher. I spent the first 10 years of my career at Archstone, and I was building all over the place in the 90s, and then I joined our founding partner, Bill Dickey, who's now retired at Dermot, here in New York, and we went on kind of a tear and built a lot of stuff, mostly 80-20, we built some 50-50s. We were in the market space, but we were building under rent stabilization in 421A. But I just think the pressures, and I like hearing from Paula and Gary, because I think the pressures on the people that are really in the affordable business, I think the pressures are at a breaking point, you know, and I'm so frustrated by it as a citizen because I think we've made some colossal mistakes, and I do think we've gotten to the crisis point, you know, and I think the fundamental reality is that we don't have nearly enough housing, and we need federal and state support, you know, massive, I can't believe we don't have more focus on this, frankly, as a country, because I don't think it can be done at the city level. You know, just the reality is, as Paula sort of said, and then Gary said, there's like too many hands in the cookie jar, and there's not enough cookies for everyone to get one. And one of the things we've done is we've weeded out. If you look at the most, you know, the biggest, strongest, the Silversteins, the Tishmens, the Brookfields. they're doing most of the development now because they're the only kind of firms that actually can really sustain what you need to go through to develop. And a lot of the more entrepreneurial part of the business in New York has been weeded out. A lot of it's going to Florida, and a lot of it's doing other things. We migrated our business to value-add acquisitions here in New York, and we've done a lot of buying and renovating over the last, now since maybe 15. We have 17 buildings now. We had 5 or something back then. So we've done a lot of acquisitions, large projects that we've been doing, substantial renovations on. So like Matt said, we've been in the rent stabilization space. We've got market. We've got about 40% of our portfolio is market, 50% of our portfolio is rent stabilized, and the rest is in a lot of different affordable brackets within rent stabilization and affordable. So we're sort of 60% affordable, including low income and middle income, and then the balance is market. So we're tilted more to affordability. And all that's, the programs are great and it's viable, but if we don't get the capital from government and support from government, we're gonna have real trouble, I think. And as it relates to 421A, it's like, as an industry, we gotta change the dialogue, I think, from not one of like, the developers are being given something, but that more like, the taxes can't be paid by rental housing at the level that the normal assessments are at. So it's not that something's being given, it's that you can't do it. And I think we all know that in the room, but we have to find a way, to manage that. And, I'm worried about it. And it's not just happening here. I mean, it is more, those of us that are doing stuff, we're gonna build one building in Miami, and, the cost down in Florida more than doubles, I mean, so the pressure on the country is massive, and it's not gonna go down very much, it never does. And the pressure is on the upside, so we've just gotta find ways to build housing, and we've gotta find ways to build more multi, and we've gotta treat it like a crisis. That's my view,
You had done some quick math when we were talking the first time a couple days ago about the loss of something like 50 to 60,000 units per year for market rate rental. Can you just walk us through
Sure.
how you got that? And just for context, it's about 244,000 units that are built in the United States market rate rental. In New York City, the city partners to do about 20K per year that are certified in some way by HPD, HDC. And then we thought 421A was delivering at its peak, maybe 25K, 30K, right when it was announced for it to sunset.
Sure. I mean, our house view has been that the reason we've been buying some buildings is that we think there is a lot of upward pressure on rents, and we think that will continue. And the fact of the matter is as Paul alluded, the economic picture is, we're a big city, so we always get muddled down with less job growth in the Sun Belt and everything. But there's been a lot of interesting job growth, particularly in tech. And Wall Street is obviously a very dynamic industry and drives the boat. And then so many other industries are a big part of New York. And we are, Fortune 500 capital, and all, none of that's going to change in our view. Like betting against New York, we think is foolish. I know there's a lot, bigger names that have been saying that a long time, but that's been my view all along. So I'm contrarian when it comes to betting against New York. I always want to bet on New York. But it's good to do other things too. When you really get down to it, it's not just 421A, right? And this taking away and putting back of a program and doing this whole dance like you're choosing your outfit is not a good way to do things, because it destabilizes everybody, and it takes years to kind of get yourself back on track. So when we start with a program, we let it go for 3 or 4 years, everyone gets their shot at it, then we pull it back on the sunset. Now we're gonna maybe drop something back in. That all sounds politically fun, but it's suicide for the business because you gotta think so far out. So we think there's gonna be very few units built after this last little purge, this little burst that's happened to vest the old 421A, right? And we think if they hopefully get something back on the books or something on the books, whatever, that would be great. However long it takes, and I hope they do, but it'll take a while for us all to adjust to that. But the other thing is the change to rent stabilization, and one of the things that's really tricky about that is there were a lot of units that were turning to market rate, which was helpful to keeping rent pricing down in a way, because it's competition. So we sort of underestimate the impact of keeping those rents below market, on what the impact to market, right? So when we think about it more like 50,000 units, we say 20, 25,000 units coming out of the development pipeline, but an equal number of units that are not going to market from rent stabilization. And not sure I'm not getting into that policy, but I'm just not sure that's the best thing. I think that's pressuring markets. So in New York, you might have gone from where in 2017 we had 50,000 market units, including rent stabilized units that went to market. Now, what are we going to have, 5,000, 7,000? It's a big difference. And the absorption numbers that come out of the research places are all pretty, again, it's hard research, but it's pretty obvious we're moving to a very undersupply situation. And that's compared to historic New York norms, which have already been undersupplied. So I think it's going to be very compressed, and I think it's going to be compressed for at least 5 years, just based on where we are, and it depends on what we do next to determine what happens after that thing. That's my view.
Any other thoughts, or should we turn to Local Law 97?
There's a lot of thoughts.
Give us a little bit. Give us a little.
So look, with 421A, I actually agree with Steve, but I guess I would just add, look, the challenge with 421A, well, really the reason we have it is because our property tax system is a black box that just doesn't work, right? And it works in one sense because it provides capital to the city and it provides the lion's share of tax revenue to the city. From that perspective, I understand and I get it, and we need it to a certain degree. But for an owner or developer of real estate, like especially on the multifamily side, the way this tax system works is just, it's untenable. And that's the reason why we have 421A and all these other tax abatements, which I'm sure many people in this room know already. But if you're looking at to build a brand new building and you don't have that tax abatement, your taxes can be north of 40% of your operating expenses or somewhere hovering around 20% of your revenue. It doesn't matter if you're doing affordable or market rate. You're not going to be able to make your deal work, right? And that's why we have the system in place. Now, there can be a lot of debates about what you have to give up in exchange for that, and that is another story, right? We have an affordable housing crisis in our city, as do many other cities do. So that's in part why we have to be able to, the city or the state needs to extract some sort of benefit. But from my perspective, 421A is one of the tools in the toolkit. It's not going to be the only answer. But it serves an incredible need because, one, it allows development to actually happen with multifamily. And more importantly, it's an engine, right? And you touched on this, Steve, where it provides predictability, right? And if you're an owner of a site or if you have something and you want to figure out what you're going to do with it, having that understanding makes the world a difference, not only when you're talking to your capital partners or your lenders, but how are you going to actually operate this building on a go-forward basis. So to me, it's incredibly important, but it shouldn't be the answer for all of the other needs. It's just one of the tools.
Mm-hmm.
Right. One thing I would just add, too, is I think picking up on that theme, and we talked a little bit about this in our conversation prior to this panel, was, there's really, I think we are heading down this path. I mean, we talk about all the time the housing crisis, the shortage of housing. We now have 20,000, new homeless immigrants that came into the city. And some of us, like I'm getting knocks on the doors asking to convert our properties into new shelters almost daily. To house those people, it's, as we look into the future, and I think you're right about 5 years, right? But in that time period, if we don't start righting the ship, we're going to really head into a far worse crisis, I think, than we've seen in the past several decades. And so, I think it's, I know, Rodney and ULI and all the other advocacy groups have been having lots of conversations about, opening up some of these restrictions that we have just to ease up development to allow it to move forward. So, with 421A on top of that, looking at the cap, the zoning cap of the 12 FAR, looking at East Midtown, does it have to remain a commercial corridor? Can we, allow for more residential? I know that conversation is heated and has both sides, but as we are trying to incentivize more residential development, there's things like zoning that are incredibly restrictive. I give the example quite often when I talk. I have, hundreds of buildings that we could convert into housing, but in order to do so, I have to lop off 30 feet of the back of a 5-story building to conform with zoning codes, and that's not feasible. And so we have to find other uses for it. I was talking to somebody who was telling me about the scaffolding laws. Was complaining about all the scaffoldings that we have in the city for Local 11, and saying, in Chicago they have 3 different categories or classifications of buildings that, if it's built during a certain time period with certain materials, restrictions are less. And I think sometimes, as we look at, just all of the rules and regulations in New York City, we get a lot more subsidy in New York than you do in other cities, a lot more public investment, there's a lot more capital, but at the same time, we're working around all of these pressures. And so I think, over the course of the next year, in order to allow for development to move forward, we really need to start opening up the conversations on some of these things that we've closed off.
So let's turn to sustainability and specifically Local Law 97. So Local Law 97 has passed for buildings above 25,000 square feet. There's a host of compliance issues to bring those buildings up to an energy standard, improve the grid and grid infrastructure, and also reduce the emissions of those buildings by 2030 approximately. How are you looking at compliance? I'll start with you, Paula, because your portfolio is probably one of the more challenging to look at that. And as you talk about it, I'm curious if you found any other sources of capital, either through the $1 trillion raised for ESG, through CPACE as a financing mechanism that passed in Local Law 96. Like, how are you trying to address these issues, or are you still trying to figure it out?
Yeah. It's a good question. So, with Local Law 97, again, my portfolio is somewhat unique in that we have a lot of very old buildings and a lot of large buildings. So of these, the Local Law 97, I think we have 160 properties that we know are immediately going to be out of compliance in 2 years. We can manage many of them. There's a whole swath of them that we have to figure out what to do with before we start, having to pay fees. As we're part of conversations, I'm working with the ULI, has a task force looking at this specifically and how we can give guidance and thoughts to the city on the policy. I think we may have different takes on 97 because of the portfolio. So the newer buildings, typically a lot of the compliance is already built in. And it's not as challenging for somebody like me and for some of our older portfolios. I think, frankly, a lot of the community facility properties that you see in the outer boroughs that are smaller, those are the properties that are really going to struggle. Housing is essentially, exempt. So residential multifamily housing doesn't have to be part of it. But every other property, every over 25,000 square feet does. I think, there are sources of funding, the Green Bank and other, NYSERDA and the state are really looking at ways that they can provide funding. The rates, frankly, don't work for a lot of the small landowners. We've been working with other smaller buildings, helping to give them guidance, nonprofits. They're in a different financial position than the Archdiocese is in, where I can sort of leverage our money from one place to another a little bit better. So 97, I think, is going to be impactful. Primarily, again, it sort of is, I think, going to be hurting our boroughs more. And I think we're going to see, a lot of properties that are going to get to that point in 2024 when they realize they're over the threshold, and we'll be looking at, I think there's going to be a lot of portfolios on the market where people won't be able to maintain the properties and don't have the money to put in, and frankly can't afford the assistance that's being provided in capital. One other thing I'll add is on my team, we're tracking all of the local laws. I think there's like 7 of them that we're really focused on right now. One that's coming up is Local Law 88. that was not supposed to come into effect for another 10 years, but I think a few years ago they slid that up to 2025. As far as I can tell, there are no rules that have been set for it yet. 2025 is really soon. And so this one it's lighting upgrades and sub-metering. So what it requires is that if you have a property of over 25,000 square feet and you have multiple tenants in that building, you have to either sub-meter for the multiple tenants or provide them somehow an estimate of what their tax impact is, or I'm sorry, their energy impact is. For our properties, we may have 7 sub-meters for one building or that don't necessarily comply to how it's sub-metered, or 1 meter for 5 buildings that are all on a shared system. And so there's, we've been asking for, support, asking whether there's any support from the utility companies as well, because there's really the compliance. I think the laws were all put in, and passed to reach a very good goal of bringing down essentially our greenhouse gases in New York City, but the way that we actually apply them, I think, is going to be a real challenge. And I think Local Law 97 is the first one. It's going to hit, and that's going to have significant impact. And then after that, I think 88 and some of the others.
And then you think about kind of just the ongoing impact of that, of something like that. Most of these city agencies are already stretched before they even have to keep track of these various laws.
Right.
And then to layer that, it's somewhat frustrating as somebody who sits on this side of the table, but at the same time, it's also how is that actually going to work?
Right.
Remains to be seen.
Yeah, and I hadn't given enough appreciation until we were talking last week to the situation for someone like the Archdiocese. Obviously, the Archdiocese will get through it, but maybe owners that have lesser means.
I'll be out of a job if we don't.
It's a big deal, and for our portfolio, which is mixed age buildings, so I think we have an average age of about 15 years. We're fine for the 2024.
Right.
And we're not assuming any housing exemptions for affordability in our mind. We're saying we have to comply. And that's the way we're pushing. So when we're buying buildings now, we're spending a lot of time. We don't have the regs yet for the 2030. I think this January or something. People here may know, but I believe it's January or so. We're supposed to see exactly more about that. So we need more. But we're starting to do a lot of upgrades in preparation for 2030. And the truth is, so whereas virtually, like you said, maybe almost 100% of our portfolio past 2024 with no work needed,
Right.
None of it, a couple of buildings, but the majority of it does not pass 2030. I assume that's the whole housing stock basically in the city, because we sort of own a lot of different types of buildings that would represent that, and so, it's going to be a lot, and we have to have a big spend in. So anything we're working on, new building designs have to be there, and then obviously retrofits have to plan for 2030 as soon as we start to get it. It's going to be pretty significant, and then maybe there'll be some exemptions, maybe there won't. I mean, who knows what might happen, but we're sort of anticipating we do it. I mean, we're not against it, we're sort of for it. Obviously, we need to make these changes, and we have found there's payback, and a lot of what we've been doing is payback oriented. So the only other thing that I might mention on that is
Good point.
we're very focused as owners on payback and bottom line. And so we've been working with Logical Buildings. If people know Logical Buildings, a great company if you're doing this at all. I don't know if they're here, but definitely a shout out. They have some brilliant folks that came out of the Mack Cali residential portfolio and started doing a lot of work on energy consumption and all that, and really became specialists in the energy space and have developed a lot of tools for owners, smart building tools basically. The technology is fantastic. We're using all kinds of building management systems now. We're basically turning things off at peak demand periods, getting huge savings by not operating. That's called a smart grid, or I think is what they call it. But basically, all our building managers get notified for peak period demands, and they literally shut the systems down. So we'll turn off the air conditioning in a peak demand period for a 4-hour window and let it warm up and residents may start to feel a little bit in the corridors or some of the common spaces, but frankly, over a 4-hour period, if you've kept your temperature there and your building is a decent building, like you actually can hold your temperature for a little while, you know, and then you get it back on. The savings are tremendous. So we've been able to lower utility bills the last 2 years by 5-6% each year from these tools, you know, and the next big challenge we all have is on the tenant side or the resident side, and we have to get the collaboration of the residents, because they're still consuming over half of the energy, right, on their meters that we also have to monitor in the LL 97. So we have to get a resident buy-in, and we have to have communication and collaboration. Some people are starting to set the meters for residents, which is a little harsh, but temperature control may be one of the ways where there's a minimum and a maximum. For us, we're trying to get buy-in, and we're trying to develop a savings program for residents so that you'll get a little, same thing we're being offered from Con Ed and the rebate. We're sort of saying if we can do the same thing on your side, we'll do the same thing with you. We'll give you that money. And that will help, I think, on the 97 calcs. But our team says we can't get there without spending money. The typical building can't get to 30 without spending money on systems and capital, and it's pretty significant capital.
So why isn't there more financial product on these items that have an actual payback? I know Department of Energy started doing research on this back when I was a student. We did some of that research with them. A lot of these have pretty high paybacks compared to what you could get today in the market for some of the activities you might do. Why aren't we seeing more syndication of that type of capital?
Yeah, I had to check when you asked that on our prep. So we have not used anything. And I know there are some products, but I can't actually speak much to it. We have not been able to use anything. So we've tended to fund with traditional financing, and then we've used equity on all this capital related. Some of it built into budgets, sometimes with the lender if we've identified the item up front, but often we're spending the money. So we haven't financed. We have had one green loan through Fannie Mae down south, which was successful, and they gave us a rebate on rate, and we did a whole green program there, which was a good program, but we haven't done it with a lender. We haven't utilized a green tool otherwise in our portfolio.
Maybe we'll see that be created. I think we probably have time for one question or two questions from the audience. Yes, sir, in the front.
My name is Charles Altman. I'm an adjunct professor at Schack. I'm working with several others on developing a securitized product to finance accessory dwelling units. Relatively small loans. My background is in commercial mortgage finance. I've had people who say, from the commercial side, who say that accessory dwelling units, individual units, are such a drop in the bucket that it's not really a worthwhile, let's say, national priority. Multifamily structures, buildings are so much more efficient as a means of providing affordable housing that you shouldn't look at ADUs. Given your multifamily experience, are ADUs a reasonable additional way of supplying affordable housing in the United States?
I would say for sure, because I think I don't think it's like a one thing fixes all. I think we need everything in the tool belt, and I think it is. While it's efficient to build multifamily, the price has probably doubled around the country, and I think that we need every means necessary. So I don't know much about what but I think it's a very viable, in my opinion, it's a very viable alternative.
I absolutely agree. I think it's incredibly important. And even though, yes, on the multifamily side, it's going to be much more efficient because we have the ability to put up large apartments, whether it's a couple hundred units here in New York or 75 to 100 units in other places across the country. To me, the bigger factor with the accessory dwelling units is how many people can actually go about and do that if something like that is accessible. So to me, I think it's incredibly important.
Let's take one more here in the front, please, sir.
Ed LaGrassa, a Schack faculty. We have an insatiable demand for affordable housing. It requires political will. I haven't seen political will. Who provides it?
You want me to?
Paula, you didn't answer the last one.
Yeah, come on, Paul. You get to go first. Ladies first.
They'll get in trouble if they answer this one.
I'll jump in. I'll say to a certain degree, it's kind of like herding cats, right? You gotta kind of build consensus with a few different people, whether that's the residents in the community you're looking to build, the local elected officials, or your financing partners. But it's important, it's needed, and there's been some major wins recently. If you look at what's been happening out in Queens, whether it's Innovation Queens or Hallett's North, or if you look at that recent approval up in the Bronx, there are things that are happening now because I think the message, one, is getting out there that we need to do something, right? And so to me, I take heart, and to me, that's a positive sign that there's some momentum there, and hopefully that continues going forward.
I'll just add one thing, is that I think it's all incredibly interconnected. I mean, I worked in affordable housing, but I didn't start off there, and then I left it. And the one thing about the affordable housing industry is that it's incredibly tight-knit because the city can't do anything without the state, right? The state can't do anything without the assembly. All the funding is coming from the federal government. When we were at the city, we lobbied for a change in some of the low-income housing tax credit policies that allowed for an expansion of what is considered affordable. We couldn't do that without years of lobbying in DC. And so, and we've all been around when those governing bodies don't get along, and it really sort of hampers development.
Okay, to finish this up, one piece of advice to students from each person, and then we'll close it out.
I was a student here, as I said, in the early 90s and my early 20s. I think it's a great industry. We need more women, we need more diversity, we need more, we need more people from all different walks of life and experience. I think you should be focused on ESG. I think it's critical. I think it's getting woven into everything we're doing. And I think it's something to really, learn a lot about. Honestly, I think the best days are still going to be ahead. I'm very optimistic about. I think we're a very important industry for America. I would like to see the development community be less hated, I guess, politically. Maybe I would go for. I'd put my hand up for that. But I hope we can work more collaboratively with government. I think here in New York, it's become terrible. I don't know why. It used to be much different, frankly, for those of us that have been around longer. Like in the 90s, it was totally different. It was a totally different experience in the 2000s. So something's just changed, and we've got to get it back to something that's a little more positive. I'm very bullish on our business. Multifamily is a great business, and I hope students will stay with it and do stuff in it.
Paul?
I think Steve said before that he bets on New York, and I would say the same thing 100%. I think for students, I always say I'm actually hiring, so come on.
Right.
But I would say you can't find your perfect job, and I think whatever opportunity you get, you just got to jump into it. And there's somebody's like worked in other markets. What I found in New York is there's always opportunity. You just have to go looking for it, and that's not the case in every other city around the country. You can get pigeonholed into one area, and we don't have that here. I've done a lot of different things in my career, and I think, if you have that interest and drive, you can really go after it.
I would agree. I can't even remember if I mentioned at the start, but I am an NYU alum, and I would say kind of to the extent that you guys can learn pieces of the business, whatever that piece is, whether it's transactional side, getting a better handle on the financing, like any of those things will be tangible that you'll be able to leverage as you get into the business. Like to me, that's the biggest thing. That plus kind of making connections and being able to talk and not being scared to ask questions, like those matter, but having some sort of base understanding that you can build on. There were times where in my finance class I would get frustrated or annoyed with some of these things, but it truly does make a difference for you kind of building going forward.
Great. Well, thank you very much to the panelists. Thank all of you that are listening.